Hello, everyone. Welcome back to The Short of It. I'm joined today by Carson Block, Freddy Brick, and Dan David. Thank you all for being here today. I just want to start out. I know there was an interesting event that happened around a short report put out by QCM about Cassava Sciences, and that is really opening the door to a broader conversation about the business model of activist short selling. I'm sure each of you are going to have some input on what this case shows us here, but Carson, I want to start it out with you.
Sure. So Quintessential Capital Management, that's Gabriel Grego. You know, he's done maybe 5 or 6 short reports publicly. He's got an excellent track record. Some of the companies that he's initiated campaigns on have been delisted, in some cases very soon after his campaigns began. So he's got confirmed frauds that he exposed, like Foley, what was the Italian? Biowan.
Globo, I think, in London. Mm-hmm. And he also did some great work on Afria and Penumbra as well.
Right, yeah. And Penumbra, even though the stock hasn't done as well as he would have liked it to have, he exposed or really put pressure on the company to recall this device that was dangerous. I mean, what had killed people through what appears to be a design defect. So Gabriel's a serious guy. His work has benefited not just the markets, but case of Penumbra, society in some way. And the controversy was that when he came out short on Cassava Sciences, and he did that on a Twitter Spaces that was hosted by Mark Cahotis. And so Gabriel came out. The next day, the company put out a response pre-market. They focused on one aspect, as I recall, only one aspect of Gabriel's report that they took issue with. And there might have been, to be fair, there might have been something incorrect in Gabriel's report, not necessarily, his fault. It was something it seemed like he couldn't have known about, a challenge to some data that had been used in a journal. But in any event, on the back of that, which wasn't really a full frontal response to Gabriel's report, the stock went up like 50% the next day. During that trading session, Gabriel's firm sent out an email to investors and maybe potential and past investors as well, stating that they had covered all of the cassava, so not to worry, they weren't sustaining losses as a result of the run-up. And I guess this is, there's a good point here, because this is something that activist short selling industry has been reluctant to discuss, really how short activists trade. And I think we probably more or less all trade similarly, because that's the nature of this business, and I think it's worth us discussing that. But there's been some criticism, including by Mark Cahotis, who's criticized some of the people. There was irony, though, because during that Twitter Spaces event, somebody asked Gabriel whether he was covering that day, and before he could answer, Mark cut off the question. And actually, I understand was, swore at the questioner, I think called it a stupid question or something like that. And Gabriel didn't get a chance to answer. And I'm assuming Mark was running interference for Gabriel because he knew or, strongly suspected that Gabriel was, in fact, de-risking that day. But yeah, I think, look, 3 of us, we know the model well. Let's talk about it. When a short activist usually goes into an initiation or campaign initiation, if you're a pure short activist and you speak 5 times a year or 4 times a year, maybe a little bit more, that's very few chances to generate revenue. And I think obviously this number is going to be different for everybody. But if I assume that we Muddy Waters speak 5 times a year, if I'm allocating the hard costs of the research, some sort of legal contingency, because we get sued I used to say every 2 years. I feel like it's maybe now more, once every 18 months. Thank you, Steven Sugarman, psycho. You allocate that, and then our internal costs on the research side. I mean, I feel like every time we speak, there's a cost of $500,000 to $600,000 that's gone into that. Now, you're not going to make money on every single one of these, and you sometimes lose money on these actually. So you have to kind of allocate that as well when you think about this. And then, we manage outside capital. Like, some portion of it is ours, vast majority is outside, and we get paid a fee. And so the $500,000-$600,000 cost is largely borne out of our pockets. It's not borne out of the investors' pockets. So when you get down to it, what we need is we need to make enough money off that to repay the cost and, hopefully actually make this worth the stress and the bullshit and, all of the things that are attendant with this. So what does that mean? That means as a short activist, you normally get really, really big right before you go public, like so big that you could be put out of business if the company were to announce, hey, we're going to be acquired, 40% premium or something like that. Like, you could be, and I think most of us in short activism have a substantial portion of our net worths on the line every single time this happens. So, if you happen to, come up snake eyes in that situation, I mean, it's a good chance as a short activist, and I'm assuming with Gabriel, but I don't know, but if that happened to him, good chance that it materially impacts his life and his lifestyle. So you take all this risk, publish, and then you have to get down to a size where you're not going to be put out of business in a day. And Cassava is a great example of how that could happen. I mean, there's no way that if we were talking about things from a fundamental perspective, that somebody who read Gabriel's report and then read the company's response thinks the stock is worth like 50% more the day after than it had been the day before. The reality there is that there's so many things that determine the price of stocks these days that have nothing to do with fundamentals, purely technicals. And yeah, to be truthful, I mean, maybe Gabriel up, on the technicals there as well, but I haven't looked at it enough to form an opinion. But that's that's the reality. It is so dangerous in this game, and if you only get like 4 or 6 bites of the apple a year, you got to make your nut like on those. So you have to be big, and then you have to be the size where you don't go out of business. I don't know. I mean, like, what do you guys think?
So yeah, I think the trading question is certainly something that's not been well explained. Certainly the rationale behind being much larger in the position and then significantly de-risking. I think one very interesting point with respect to Gabriel's work is actually he dropped it, I think, prior to market or maybe around the market open. And initially the reaction was actually somewhat in line with what you'd expect. I mean, Gabriel did some what looks like really good work. He found some fun, quirky stuff about the people as well, which is a lot of the time what we're looking into as well, the actors behind the promotes. And I think the stock at one point was down 6, 7, 8, 10%. And then intraday, it actually traded up to flat and maybe even
it actually went.
Right,
it went back in the green.
Right, traded up on the day. Given the technical, and I want to say somewhere between 20 something and 30% of the float was short, and it was also a meme stock. I think his actions made a lot of sense. Going back 10 years when most of the short activism was focused on Chinese reverse mergers, the reality is the dollars that people were putting to work in these trades and the outcomes were considerably more certain because you didn't have meme stocks, you didn't have the amount of passive you now have in the market. And so while the long-term outcomes, as shown by a lot of studies from activist short selling, generates significant alpha, ironically, the 1 to 2 or 3 day window when people are supersized in these positions relative to their fund size, and even still, it's probably not significant dollars relative to what very large funds have in other long or short positions. We're still talking relatively small amounts. The outcomes have become significantly more random in a short window. And while a lot of the trading in the early days was largely predicated on, okay, the firm itself is very small, the research is very expensive, and in order to continue to do this, we need to make sure that we realize some amount of profit in order to actually be able to grow our firm. The risk management approach now is largely because the outcomes have become considerably more uncertain. And part of that as well is that management teams have learned how to deal with short activists. 10 years ago, it was this completely new, somewhat revolutionary form of sort of investigative journalism that found its way onto markets. And companies had no idea how to deal with this. Now there is a significant playbook. The playbook's probably along the lines of, if the stock doesn't move, forget it happened, because if you address it, you bring more attention to it. Should the stock move, you can sue the short seller. Regardless of whether that's effective or not, it will certainly likely silence them and probably have the impact of, costing them considerable amount financially. You trot out a press release explaining you were taken public by fill-in-the-blank investment bank. You potentially do one of these, internal investigations where, call us skeptical, we think you largely pre-agree the outcome before you even enter the investigation. And these are all things that have been shown to be somewhat effective in pushing the stock back. So while the cynical view is, how can you come out and say this and then go and do that? The more practical and realistic view is, it comes down to risk management, both in terms of being a fiduciary and having a significant amount of your net worth invested. And to a certain extent, it's partly a reflection of what has become an increasingly random distribution in markets that are more affected by technicals than they are fundamentals. And so while we, in many cases, have been in positions where we've de-risked a trade quite significantly and left what most people would call a sleep at night, 1-2%.
Sleep well at night position. Yeah.
Sleep well at night position. We still find ourselves where, we might continue to publish on a name, or we might find new additional information that's interesting. And ultimately, we still might be in a position where that stub position has eaten into P&L of our position, and that's assuming it's one of the times where we've published and markets have actually taken, somewhat our view at face value.
Or eviscerated the profit and then turned into a loss. GSX.
Right.
Once again.
And equally, I think it's important to realize, look, as in the case of Gabriel and Cassava, and I don't know whether he did or didn't make money, we've had significant occasions where we've published a thesis, for whatever reason, the market has shrugged it off, and, a quarter or, 6 months later, our entire thesis is played out. I get all these wonderful congratulatory phone calls with, I assume, people who think we have like a massive position, everything's great, and you're kind of sitting there thinking, wow, this is really fantastic. Like, lots of other people shorted this because of our work, because it was accurate and correct. And, based on our model, we made negligible amounts of additional money. And, other than the moral victory, which is important to us and helps continue to build the brand of short activists who are correct, it doesn't really do a lot for either us or our investors. So it's this, slightly hollow position to be in. And I can think of a number of times we've been there, and it's kind of bittersweet, to be honest.
It's really interesting you say that about, how important it is to de-risk right after these reports, because oftentimes the company is pulling out all of the stops in trying to refute that report. On the chopping block, we've had about, I believe, 14 ideas come out, and I keep track of the data on those. And on the one day, you see it's a pretty high batting average in terms of the stocks going down, and the average return is around negative 10%. If you go out to about a week, the average return is there, but that hit rate has come down to around 50%. So half of the stocks are either flat due from prior close or up. Now, if you zoom out even further, the stats continue to get better. The hit rate improves back down to that around 75% batting average, and the average returns continue to go down. But the risk really is in that initial period right after the report for a large majority of these ideas that are coming out.
Yeah, that's exactly it. And a lot of times that's a combination of not just the company's response, but also technical factors. The borrow is a lot more expensive. Lots of things are going on. So yeah, it's interesting that you've done some research on this. You have some data on it, because it's just doing this for 11 years. It's what I've observed, whether it's us or other short activists. Yeah, it's usually, it's going to bounce. But over time, at least the short activists who have staying power, what really matters is our brands, and like if our ideas sucked over the long term, if we were wrong a lot, nobody would listen to us. You wouldn't have it day one. So it's, but it is really interesting that you have that data showing that, yeah, you go through this interim period where there's a lot of chop from the short activists or from the short sellers perspective after the announcement of the campaign, until things settle down and you get your win.
Dan, does this match up with your experience?
Excuse me, I couldn't hear anything that was just said. Could you guys repeat all that? Talking about the Cassava report itself, for me, I look at the report and the facts. I think Carson said it. You look at that report, you look at the response, and it should trade the way it trades. And one of the things that's not brought up, number one, I never could get short. The borrow was very, very hard to find by the time the short was disclosed. You can get some here at a better price, which I very well may do. And I have nothing to do with Gabriel or certainly Mark. Having said that, what Freddy was talking about on what it was like short selling 10 years ago, look, does anybody ever remember when NASDAQ or NYSE gave an actual what happened in the markets? No, they do nothing but collect fees. And I can provide you guys with a video on a company called UA. The ticker symbol is YUII, UA International. And right after that conference call where it got halted, we had maybe an original Reddit guy from 10 years ago go on YouTube and absolutely flip out that the market, that NYSE halted them. Why did they halt them? He wants to be able to trade in and out of it. He wants to do his thing, as I'm sure many people on Reddit want to do their thing. But it seems like when a short seller wants to do their thing and manage risk, that somehow that's wrong. And I don't think you can have it both ways. In spite of what Mark, berating that guy that asked the question that, Mark is constantly asking and answering for himself on behalf of others, it makes no sense. We should be able to manage the risk. Now, that doesn't mean anything nefarious or spoofing the market, which I have no idea how to do, and I don't know anybody who does. But this naked short selling, I have no idea how to do it. Not a broker, not a dealer, not a market maker. So how does that get done? All of these things that you think are happening are really not happening. It's just managing risk the same way you want to do it on Wall Street Bets, or the guy in UA wanted to do it 10 years ago.
Well, I wouldn't want to compare like prudent risk management practices to Wall Street Bets risk management practices.
Right.
Just it.
Why? It's a whole microcosm of people. There are thousands of people on there from all different walks of life, and some of them are very, very savvy investors and know how to manage the risk and know what they're doing. So, sure, when something's played out after a day, everybody who was right becomes the leader of the board, right? When it goes the other way, it's like CNBC. You bring two opinions on one day, the guy who was right comes on the next day. That's just, the same thing they're doing there.
You talked about the position, Carson, about needing to get that revenue in those 5 times while you're speaking. And then we've also talked about risk management. How much of it as well is funding these positions? Being able to carry a short in your book is expensive. Dan talked about not being able to get borrow. How much of getting big taking that profit is also just funding your ability to remain short in those names and other names that you might have for more longer term bets.
Well, sometimes you're not taking profit. Sometimes you're just realizing your losses, by the way. But there's also a point here that has to be understood. If you back up, not only as a short activist, do you get just a few shots a year to fund your business, but you also have to look at this. The essence of how you get paid is through short selling. Well, what do you need for that? You need access to borrow. And if you try to do this with just a retail brokerage account, or, I mean, the closest thing to institutional you can get without being institutional is Interactive Brokers. And it's a fantastic platform for retail, but you don't get, like, we can have conversations with borrow desks to understand how stable is this borrow. Sometimes they say, yeah, this borrow is not very stable, so don't bank on having that. This borrow I feel okay about. And look, they can also, if you're a good client, kind of fight to keep with lenders to keep you in positions. So when you get to the institutional borrow world, it's so much better than when you're trying to do this retail. But what do you need to get to institutional borrow world? Well, you need to have a bunch of money. So when I started out, I had a negative net worth. And so you have to raise, you have to raise capital, really. I mean, I think, because if you're already worth a few $100 million, like, don't do this. Like, the upside downside's not worth it. But you have to have that outside capital. So, okay, now you have this outside capital that allows you to get in the door with, prime brokers and have ISDA agreements. And you need multiple primes, because sometimes this prime can get you stock, this prime cannot. And you have to feed them. So they have minimum capital requirements, and that has to do with the ISDA credit onboarding process, or their credit requirements. But you also have to feed them and give them commission business and financing fees. And again, that means you have to get your positions big so that they can generate their commissions. But, positions that big will put you out of business if you hold them. So this is a way in which, if you look at things from the long side, you probably, if that's your background, you probably don't understand this and the pain points that exist just from an operations perspective when it comes to short selling. So that's another reason why you do this and get big. But that also leads to why there is a balance sheet provision business. Because when you look at most short activists, the companies that they're publishing on are not the capacities of those trades. Even if you're going to quickly de-risk, the capacities of those trades aren't big enough to justify raising enough money to make it worthwhile. Because if you raise $50 million, maybe that gets you a prime. But the problem is you've just massively increased the complexity of your business, because now you're regulated as an investment advisor, and now you have all of this back office stuff that needs to be done. So you increase the cost of your business at the same time that you raise outside capital. So even at 100 million, that was our first raise. We had a client put us into business, said, here's 100 million. Even on 100 million with the management fees, I mean, we lost money because of the increased cost of the business. It wasn't until we had a lot more in assets under management that we were able to get to that, closer to that break-even point. So that's another issue that you get to that shows you need to have large trade sizes initially. Anyway, you can't hold those things for reasons we discussed, but also why there is a balance sheet provision business in this industry where most short activists just can't. They couldn't use. It would be disastrous if they tried to raise money to manage for their short activism.
So Carson, you hit on pain. I want to talk about pain a little bit. So while on the long side, if you have a position that goes against you and it halves, your thesis still holds true. It's probably in the long term not a disaster. We actually were involved in a Canadian gold miner earlier this year that in the prior year had put out some information that was poorly interpreted by the market. The stock halved, didn't feel fantastic, but at the end of the day, it actually enabled us to buy more stock in something we had, higher level of conviction in, because we understood the way the information had been misrepresented, and actually allowed us to increase our position. So net, if you still believe in the thesis, that is not a disaster for you, while it might ruin the month and certainly your day. But on the short side, the pain is just indescribable. Now, it's nice to sit there and think, hey, firstly, you've done all this work. You have a significant amount of conviction in your thesis. The report comes out, no reaction. So not that anyone's going to feel sorry for us, but it's pretty hard for that not to feel like a referendum on your intelligence. So there's kind of the...
Actually, your worth as a human being.
Oh, okay.
Yeah.
You feel it worse than me? Good to know. I already know what people think of me as a human being, so I'm all right.
We could go over it again.
So you have that piece, but then you have the risk management piece coupled with probably what's going on in your body on a chemical level, not feeling fantastic. So, we've had examples where we get squeezed in things and you're sitting there with a significant part of your own and your investors' cash on the line. And it's really nice to think that in some ideal world, you can sit there like you see in the films, and it's this icy cool thing where, you just cool the desk up and you go, put more on, I can handle it. But that's just not really how it works. And, there are examples I can think of where, we went to bed the night before the trade, waking up tomorrow, and we could think, hey, if tomorrow doesn't go really well, this could be a significant problem for us.
Yeah, I've gone through those scenarios of what will it be like to tell my wife that, hey, I think we need to sell our house because we just got wiped.
Right. And, that could be something like, maybe the company found out we were going to release a report and they pre-announced something before the market. Maybe we just get really unlucky, and the day before some other large corporate actually thinks it's a wonderful business, and there's a story in the news that there's going to be a preemptive bid of the company. Or maybe it's something as just dumb luck, unfortunate as, you're looking at a clinical company who's going through trials and the endpoint data is supposed to be in 15 months. And turns out there was some really positive data that no one anticipated. And the night before your report, they think they've, cured Alzheimer's, and the stock trebles and you're out of business.
Or at the risk of turning this into a therapy session, there's, the times that we've been front run because somebody has, figured out what we're doing and they've broken promises to us. And so there was that one a few years ago where we were pretty risked up, and we realized just the day before we were scheduled to publish that we were being massively front run because in the put market, somebody was trading like they knew something, and it wasn't us. And we started walking out of the trade, and eventually that put buyer became a put seller. And guess what? By the time we got out of that trade, we had lost $9 million. It was real money that we lost on that. And that wasn't a buyout announcement or, any other sort of announcement from the company. That was just guys in the market trying to us. So, yeah, there are lots of reasons why this is not, this is not an easy business, and you're taking a ton of risk. And then there are the death threats. So, that's what makes it all worthwhile, right, Dan?
Those are fun. The reality is with the threats, that they are what they are. But the four scenarios that you brought up about buyouts, about BS press releases from fraudulent companies, the day of, because they're a fraud, right? They can put out any press release they want about being front run. All of that has happened to me, every bit of it. And, if you want to join in on the profit, then why don't you jump on in on the losses too? And let's see how you like that. So I'm not on here to ask anybody to feel sorry for me or to say that, this is a business model that I'm sorry that I'm involved in. I'm staying in it. I don't care how tough it gets. I can't sing. I can't dance. Broadway's out. So short selling is going to stay in. And I don't really give a what some old-time yappers have to say because they didn't manage their risk 10, 15 years ago and blew up their fund. I'm going to manage the risk the way it should be managed, that, accounts for every LP and every person in an appropriate way. And if you don't like it, go invest somewhere else.
Dan, I know Broadway's out for you, but given it's November, have you thought about Panto? They do have roles for short guys like us.
Have I thought about what?
Pantomime?
Pantomiming. No, but I don't think it's at all shocked that you have thought about it.
Well, look, what we are trying to do here is give clarity on the business model of activist short selling because of the massive misperceptions that are out there. And I think one of the misperceptions relative, Freddy, you touched on if you're looking at it from the long side, but a lot of people look at it from the short only and, for lack of a better word, passive short side. And I think as well, it's helpful to talk about the differences between what a short book, which is, a short book which is sitting there, they're not actively talking about their names, but they are 100% short. Usually they're some sort of hedge that an institutional portfolio with a long bias is putting on. I don't want to single out any specific funds, but I think we all know the types of funds I'm talking about. Could one of you talk about the differences between what your book looks like at any given moment in time, when you are about to publish, maybe when you're sitting cautiously in between reports, and then what their book looks like?
For the short sellers, the traditional non-activist short sellers, the ones who've stayed in business, and most of them have not, they generally size their positions, I'd say on the low side, 20 basis points of assets under management, which is 0.2%, up to maybe 2% for initial positions. And so when you think about Kynikos, so Jim Chanos' Kynikos, he said publicly, generally positions are 1% or 2%. They hit 3% because they've gone up. They have to have meetings about it. And this has been a really tough business for everybody. But the reality is even having positions that small, it's been tough. I mean, if you look at the forms ADV for the short funds that are still around, including Kynikos, I mean, AUM has just done this over time. So it's still really tough, even with those very conservative position sizings. And that's also one of the things, when people get really tinfoil hat about short sellers, well, I guess, since keep the meme stock thing, maybe this isn't on a relative basis that tinfoil hat, but people would always say when Jim would go on TV and talk about Tesla or one of the other positions.
I think that it's really a business model and a valuation issue with Tesla. I mean, there's some things we don't like about their accounting as well. But, this is a company trading at $500 billion market cap. It'll have revenues this year of $30 billion. And despite what everyone says, they're still an automobile company. They make cars, and so they're competing with other companies that make cars, and increasingly those other companies have EVs as well. And so, Tesla, every bull market has a stock that people pin their hopes and dreams on. Back in the .com era, it was Cisco and Yahoo and a few others, JDSU. And certainly one of those stocks this go around is Tesla.
Like, oh, he just wants it to crash so that he could make, Elon used to accuse him of this, hundreds of millions of dollars or something like that. And it's like, it's a few percentage points, guys. Like, even if it went to zero, I think the victory is more of a moral victory in the case of a Kynikos or, other short sellers that managed to stay in business. So that's the reality of how you run a short book that doesn't blow up, especially post-global financial crisis. Now, the interesting thing, Max, you've asked this question about what our book looks like. Because we're in the balance sheet provision business, and we really, we got into that a few years ago, we're able now to keep on a number of positions at any one time that makes it look something closer to, a normal looking book, because it's not just the, 4 or 5 times a year that we're going to speak. And we've actually launched we have a new strategy around that where the positions are actually sized much larger on a long-term basis. And we've been saying to investors, like, look, we think that this strategy will earn higher returns than the original flagship strategy, but it's going to be more volatile. Only because we provide balance sheet to some other short activists do we have the ability to build out this book with a number of positions that's kind of diversified. And we're running that in larger sizes on a longer term basis. But
yeah, and I think part of what has made the short only sort of passive, not going out there speaking about your positions business even harder than it already was is ETFs and smart beta type strategies. So if you spoke to some of the guys who are in that business, they would tell you, look, not only do we have small positions, but we are short, only frauds. Okay. So we've got 200 frauds at any one time. We typically believe that, within a 5, 7, 10-year cycle, these things go to zero. So that's why we can manage the risk by trimming on the way up and adding on the way down. And eventually net, you should make some money, less your borrow cost. But the way that markets have changed with factor-based investing, what was previously 200, 300 reasonably diversified bets has actually become, in many ways, like one bet. And so what we saw last year with the Wall Street Bets crowd and continuation this year through GameStop is certain attributes of companies, be it high short interest, significant liquidity, although limited floats, generally like absurdity of business model. Those are the kind of things that have been targeted for ETFs to own or for certain groups of people to buy, either to squeeze or because outright they just believe these are great companies. And it's made the risk management piece significantly more difficult. So while you might have had, I think 10 years ago, an easier time from a diversification standpoint going after 200 frauds, I think the window on risk there has massively narrowed. And I think, look, in general, short sellers maybe are not as market savvy in terms of some of the mechanics of what has been going on underneath the market. I certainly, until I think, saw some of the Mike Green stuff, was not necessarily aware of what was really causing the squeeze in some of the stocks that we were shorting. And so you had this massive informational disadvantage on top of what was just generally a difficult / business model to be in. And then I think the other problem with, non-activist short selling that made it a really difficult business model was we feel that you need to do a significant amount of additional work to be short something because of the obvious lack of asymmetry. So if you look at a long-only concentrated asset management business, you can probably run $10 billion with about the same number of people you can run $1 billion with. And you can quite possibly, in some cases, run $1 billion with the same number of analysts you need for $100 million because things scale. That's just not the case on the short side. If you are doing a significantly larger amount of work, you're going to need to hire a significantly larger staff. And given the nature of short alpha being generally a smaller number than what you're going to get paid for like absolute being long beta, it presents real challenges for the business model. It's lack of scalability and potentially lack of allocators who have interest in pure alpha relative to beta. So it just makes it a much harder business model to scale than potentially a traditional long-only active management business or a hedge fund that's short a bunch of indexes and, broadly speaking, long some kind of idiosyncratic stock picks they have on.
Yeah. I mean, if you look at Kynikos, they used to, at least I don't know if they do it this way now, but they used to have 70 to 80 names in the book. So that's the bottom of the funnel, 70 to 80 names. How many, what's the top of the funnel? How many names must they go through doing more work, a lot more work than the long side does to get down there? And, you need real AUM to make that work.
Well, not only that, there's the treadmill aspect. If you're a really good short seller and you ride a lot, that's great. Find something new. If you're great on the long side and you find something cheap and it becomes, one of like the best performing stocks of the next 10 years.
You're a compounding bro.
You're a compounding bro, and relatively, you kind of have to do a little bit less work than if you're a good short seller and you're finding something every year that goes to zero. So, there's significant differences on the short and the long side that make short selling less attractive from a business perspective.
Well, what about, what does big mean to you? I did an interview with a bunch of different short sellers for Real Vision in our Festival of Learning, and Keir Kalan was our resident activist for that one. And we asked him that question because we had Midwest Hedgie talking about what it's like to run a long short book. We had somebody doing the capital structure, relative value side of the short selling biz. And they were just astonished, floored, both of them, when Keir said, yeah, sometimes I'm like 85% in one position going into a name. I mean, is that the type of size when you say we're getting big and it's existential to our fund?
Yeah, I mean, it could be even more than that. It really, it should anyway. The way we look at it, it depends on the liquidity of the stock. But the idea is, because you get just a few shots, the more liquid something is, the more risk you can put on. And our LPs understand, like, that's the nature. They want us to swing big as long as it's prudent relative to the liquidity of the underlying. That's the nature of this business. So 85 is not a comfortable place to be, and it's not somewhere we find ourselves frequently, but there have been times we've been well in excess of 85. So
now we think long and hard about hedging the horrific scenario of the day before something happens, or even trading in. If you are trading in that significant an amount of your AUM, and you're shorting something and it turns out that there's some presidential decree that's going to affect all the stocks in that sector, you can be on the wrong side of a massive factor or beta move. So
fucking
we think
Scotland.
So we think long and hard going into a trade actually about not how much money might we make, but how much money might we lose. In fact, that is a continued fear of us, and when things go well, it's generally more of a relief than a scene of high-fiving, because even when things go well, it's not life-changing for anyone. It might help make a good year. You feel good about it because, ultimately it's the market validating the work you've done, but it's not without a contingency for a lawsuit either.
Right. Well, the other thing that I think is also important to understand, my view is, the analogy I've always used for the way these campaigns unfold is we serve, the company returns serve, and then we play the point at the net. And usually the short activists, the ones who are still here, win. But what I mean by that is, company, if you have a good day one as a short activist in terms of the market reaction to your piece, the company will come back with everything they have. And there are short activists who specialize in microcap space where a lot of them don't have as much savvy in terms of how to respond, or they don't have the resources. We tend to play in the mid-cap space. And every crisis communication firm in the world is calling the company the moment that the report hits. They usually prepare this big response for the second day. It's often very misleading. They answer the questions they wish they were asked, not the ones that we actually ask. And it's full of ad hominem attacks. And really that, I think especially just because of the technicals, usually the company will win day two. So it's like, and sometimes they win, for a while going forward before things fall apart. But if you believe that the company wins day two, again, I pose this question: do you have a duty to stay lying down on the railroad tracks, get run over by that train? I ask the question because some people have suggested that, yeah, you have a duty to, to sit there when you know the company is going to hit you with everything they've got. So personally, I don't feel like there is such a duty. And if a rule were ever promulgated that says that you need to stay there and you can't de-risk or whatever, I guess that would be I have a really hard time believing that's constitutional if we're talking the US, because this is investigative reporting. I mean, you look at the value of the stuff that Gabriel has published, right? Or any of us, or almost any of us as activist short sellers. And there have been some real problems that have been outed by activist short sellers. So if you publish and somebody's already short, somebody you don't know, or somebody who doesn't know you were going to publish, they're short, you publish, stock does what it does. This person who was short, they get to cover immediately. They can cover entirely. They could even go net long, if they want. But you, as the activist short seller, you're handcuffed. You know that they're going to come at you the next day, with everything they have. This guy gets to trade, you don't. And the reason you don't get to trade is because you spoke, and you spoke on a matter of public importance. You were an investigative reporter, and now you're being punished for that. And P.S., the lawsuit is coming, within a few months in many cases. So I have a hard time seeing how that is a level playing field. But maybe for people who are not in this business, maybe they do think that's fair. I don't know.
Well, guys, we touched on so many things today. Thank you all. It was an interesting one and a great way to pull back the curtain a little bit on the activist short selling business model.